Hey everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. Well, everybody has heard the name Doug Casey, the Perma Bear. Well, we don't have Mr. Casey here today, but we do have Louis James, who works at Casey Research. He's the senior metal analyst. Louis, thank you very much for coming on the show.
Pleasure to be here.
I appreciate it. Now, I mentioned Doug Casey. He's a well-known guy, wrote several books, really mostly talks about depression and Armageddon and very scary things, okay? I think his outlook right now, I think he's out with a new one calling for the Greater Depression. Is that right?
Well, there's not a new book out yet, but yes, that's the outlook right now, the Greater Depression.
So we had the Great Depression back in the 1930s.
Right.
This is going to be, according to him, the Greater Depression.
A financial apocalypse now.
Ooh, that does not sound good. No. Based on what? I mean, granted, things are not so great right now, but why is he forecasting such a cataclysmic scenario?
The short version is all the mega trends that he likes to follow, demographics, economic trends, political trends, his guru sense, if you will, it all comes together and points in one direction. He believes that government policy over the last decades has really just kicked the can down the line. You know, he called for trouble in the 1980s, and it's been put off. And now it seems to him that that's at the end of the rope.
What kind of
metaphorical
policy? Are you talking about basically the debt, the spending?
Debt, spending, money creation. I know we can disagree about that a little bit, exactly what constitutes that. The printing press, Bernanke and his helicopters and so on. All these things, the trouble in Europe, all converging. You know, to believe that everything is fine, you know, to believe that this recovery is real, that Obama has saved us, everything's going to be hunky-dory.
Well, I don't think everybody believes that. I think there are many skeptics, and I think such things as the unemployment rate or the sluggish nature of the economy would belie any claim that, you know, the economy has been saved. I think it, you know, far from it.
Right. So that's bullish for gold. You know, you've got that as, you know, if that's the good news, is that it's a sluggish recovery. You've got Europe disintegrating. You've got to believe that the Germans are going to be happy to pay for France's new socialism. That's not a bet I want to take. You got to believe that the Chinese and the Indians are going to buy more of their own product. That's not a bet I want to take. There's a lot of bets that I really wouldn't want to take to believe that, you know, we're back to the boom years, things are going up, and that gold was, you know, that was it. $1,900 peak last year, that was it, and it's down here.
So the main, I guess, hedge against this forecast would be to buy gold. Is that it?
That would be the number one hedge. You know, silver too. It's the other monetary metal. And this is interesting. You put a hedge against economic doom and gloom. That's really a way to look at it. You buy gold for prudence. So this is Doug Casey speaking. I'm channeling Doug right now. You know, you buy gold for prudence to speculate on the vicissitudes of the market. You buy the stocks. Gold is for prudence. And ultimately, you know, come heck or high water, an ounce of gold in your hand is some physical asset. You know, Doug likes to say it's the only financial asset that isn't simultaneously somebody else's liability. And somebody will take that gold for something. 300 loaves of bread, you know, gas for your car, something you need in the future. Gold is for prudence. If you think you know which ways the markets are going to zig and zag, you know, the gold stocks or the mining stocks in general are a great way to play that. Because whatever the underlying commodity does up and down, the stocks do even more.
Now, you said, you know, basically you're looking at a much weaker economic environment. Yet, if we look back just over the past year, when we saw growth in the United States go from a 3% or slightly over rate, now down to a 2%, maybe in the 1% handle this first quarter this year, gold has been going down. We haven't seen a positive correlation with gold to the slowdown in the economy. So what makes you so sure that, you know, if the economy continues to slow, that suddenly gold's going to go back up?
Well, I'd say two things. One is gold did go up in 2011. Of course, it hit its nominal peak, the 1900 peak that we had last year.
Right, when the economy was expanding.
Well, okay. Well, it was also coincident with the debt ceiling crisis, right? You know, a lot of fear went into this. And this is actually a really important point. There are some people out there that like to talk about, you know, the fundamental supply and demand for gold and what the price of gold should be. I think this is very silly. There is no should be, because ultimately the supply of gold is almost infinite. Unlike silver or other metals, it doesn't get used up. Most of the gold ever mined in history is still sitting on the surface of the earth.
But isn't that fundamentally bearish? I mean, it's not like oil, you burn it, it's gone.
Yeah, no, that's the point, yes. Hold that thought. So, you know, the gold is still there. Why isn't it flooding into the market? because of fear. People hold gold for prudence as the fundamental, safe haven asset. So really the determining factor, the driving force for the price of gold is not, the supply and demand and mine supply. That's all marginal. It's a bottom line fear barometer.
So you're saying that people will never have to, quote unquote, monetize that. They won't have to sell it. It becomes money at some point, which is used as a medium of exchange. Like if things get really bad and you need to eat, somebody's going to take your gold bars or your gold coins. Is that what you're saying?
That's the ultimate backstop, yes. But between here and there,
and you're
supposing we don't go to Mad Max, right, driving around in the desert, it's still an asset people will take.
Okay, well, how about this? If you have a tax liability, you live in the United States, right?
I do, yeah.
If you have a tax liability to the U.S. government and you need to pay the IRS, and you go there with a bar of gold or some gold coins, what's the IRS going to do? They're going to tell you, go sell that and give us U.S. dollars. Are you saying that at some point down the road, the IRS will say, forget about the dollars, we want your gold?
The state of Utah passed legislation enabling exactly
right, but that's not the federal government. States
but
do
it's
that.
A bellwether kind of thing. That's a striking straw in the wind, isn't it? If a state government passes such a measure, doesn't that sort of tell you something?
Personally, I think it's a silly measure because if a gold standard, the way it works is it fixes the quantity of money. So if you think you're going to grow your economy by fixing the quantity of money, then basically your economy becomes a zero-sum game where some people have the money and some people don't.
I disagree.
It's been that way for 5,000 years until you went off it.
Well, no. It's close, but not quite, actually. There is mining. I said it was marginal, but there is mining. And it turns out, this is an interesting thing, it turns out sort of the natural growth rate of gold on the surface of the earth is about 3+%. That's what the mines and discovery rates over history have averaged out to. And it turns out that if you're trying to grow a stable economy, and you need, got a growing economy, you need more money in circulation to accommodate that.
Correct.
But that's a pretty healthy level. That's a manageable level.
I think the Chinese would argue differently. I mean, a 3% growth rate for China would be a depression. But anyway, it would be. I guess it would be good for us. We were growing at 3% at one point last year.
I'm talking long-term historical averages.
Okay.
China has some very interesting peculiarities of its own now. Another conversation.
To be sure. So let's talk about some price levels. Where do you see gold going, let's say, in the next 5 years, in the next 10 years?
Oh, wow. Those are pretty long terms. Most of my subscribers, they want to know, what have you done for me lately? What should I buy now? Where is it going next? It sounds crazy to say this, but there almost is no limit. If you were to actually go back on a gold standards, there are different calculations ranging from $10,000 to $40,000 an ounce.
You think that would ever happen?
To back the dollar. In other countries that have gone over the edge into hyperinflation, which people say it can never happen here, but when you get stuck between a rock and a hard place, very smart people do stupid things because they have no choice. And if such a thing were to happen where it became politically necessary to do something, what they do is you've got the Yugoslavian currency goes out of existence. You've got to replace it with something. They replaced it with Deutschmarks. When Zimbabwe had its hyperinflation, they basically said, hands off. You can use whatever currency you want, and it dollarized things.
Yeah, well,
so you replace what doesn't work, what isn't accepted, with something that is. So yes, I believe it actually can happen.
Well, that in the examples you just gave. The problem with those examples is that, when you start to denominate your debts in somebody else's currency or in some unit of convertibility, yeah, that could happen. But the United States, all of its debts are denominated in dollars. I mean, it's
very interesting. It would be a tumultuous change, and this is why Doug is calling for the Greater Depression. These are not easy things. But just because it would be painful, just because the prescription, if you will, is chemotherapy, and that's serious business, it doesn't mean you say, well, we're just going to live with the cancer. You don't live with the cancer, you die with the cancer.
But yet, despite the fact that since 2008, when the Fed started to engage in these extraordinary monetary measures and et cetera, we have actually seen dollar-denominated. The dollar itself has gone up. If you look at the dollar against a basket of currencies, the widely followed dollar index, I think it was something like 72, that index back in 2008. It's at over 80 right now. If you look at Treasury securities, all right, they've been like the best performing asset out there. How do you square that performance with the argument, with the money printing argument?
And it's interesting that in 2008, The treasuries were the only asset besides gold itself that didn't get just cratered, right? And gold did go down, but came right back up again. Two sort of broad answers. One is you have enormous advantages in being the reserve currency of the world, and you can basically export your inflation. And this is why we see the race to the bottom. You see Brazil trying to desperately devalue their real, and other currencies trying to do the same thing. The Colombian peso, of all things, they're trying to inflate to keep up with the dollars that are flooding into their country. So
that's just bad policy, though. You don't have to do that.
Well, I agree, but it's the advantage of being the reserve currency of the world. Now, as that changes, your ability to do that changes, and as sometimes the Chinese start saying, "Well, maybe we should start doing business with Iran and something else besides dollars." The rules of the game are changing. It's a very interesting time. So all these things that have been done since 2008. It's, Bastiat, you go back a couple hundred years. The thing about economics is you have the seen and the unseen, the immediate and the delayed effects. The off-the-charts responses of 2008, post-2008, have to have consequences, economic consequences that lie yet ahead of us.
I keep hearing this like, oh, there's going to be hyperinflation, there's going to be inflation. It's just, that's like me saying, one day the sun is not going to rise in the east. Yeah, it won't, because there won't be a sun, in 10 billion years. It's useless information, isn't it?
No, 10 billion years is a long time.
No, but look, in 1980, the national debt was $800 billion. Today, it's over $15 trillion, and interest rates have gone from 20% to zero. I mean, that's 30 years ago. We've been saying, watch out, watch out, watch out, and it's never happened. I mean, at some point, don't you just scratch your head and say the thesis is wrong?
If things were going, 2 steps forward, 1 step back, and just kept going, maybe you can think you can keep kicking this down the road. But so many charts of so many different economic indicators and figures have, gone off the chart one way or the other since 2008. How can any sensible person look at that and conclude, yeah, we can keep this up? This is the new normal. $1 trillion deficits, that's the new normal.
Well, it's been, that has been the normal for 234 years and longer. But I would agree with you on this. For any country that is not a currency issuer, right? If they're a currency user, if their debts are denominated in somebody else's currency, or if there's some convertibility there, yes, that could be a huge problem, and that would absolutely apply to the Eurozone countries right now. But I would say for countries like the United States or Japan or the UK or China for that matter, it's not a problem. But anyway, $40,000 on gold. That is.
I didn't say that was my target. I said that was one estimate.
That is very seductive. You might almost get me to buy gold right now.
That's remonetizing the dollar and something real backing it, right? Looking at the market, way things are going, and so on. I fully expect with the fluctuations ahead of us to see $2,000 gold very easily.
Okay, well, we almost touched that.
Yeah, that's right. That's very easily. Can it go to 3,000, 4,000 before this, bull cycle is over? Never mind monetizing the dollar, but just this cycle, looking at it as a cycle and not the end of America or whatever. I can see $3,000, $4,000 gold, maybe $5,000 gold, but my near-term target is actually $2,000.
All right. Well, we'll have to see. Very interesting discussion. In any case, Louis James, thank you very much. That's it for now, folks. We'll see you here next time. This is Mike Norman saying bye-bye.